Central banks are rapidly increasing their gold reserves, purchasing over 1,000 tons of gold annually. This is not a coincidence, and it raises an important question. Why the aggressive gold buying? We'll examine the economic and strategic reasons behind this trend, focusing on fundamentals, history, and long-term financial logic. By the end, you'll understand gold's growing importance in the global monetary system. Central banks are buying over 1,000 tons of gold annually, a level not seen in decades. What risks are they preparing for that many investors may be underestimating? The reasons behind this aggressive gold accumulation are both economic and strategic, rooted in long-term risk management rather than short-term speculation. Gold has always held a unique position in finance. It has preserved value across centuries and different monetary systems. Unlike currencies or government bonds, gold carries no default risk, no political obligation, and no counterparty exposure. It is the ultimate asset free of promise. The confidence in bonds weakened significantly after the 2008 financial crisis. Since then, central banks have steadily returned to gold, accelerating purchases in recent years. The first key reason is diversification, particularly moving away from reliance on the US dollar as a primary reserve asset. Sanctions and frozen reserves have highlighted that dollar assets are not fully neutral. Many nations are reducing dollar exposure due to increasing geopolitical and financial risks. Countries like China, Russia, India, and Turkey are increasing gold holdings to strengthen financial independence, as gold exists outside of any single political system. The second key reason is the growing structural geopolitical instability, including global conflicts and trade tensions. Historically, gold has served as a stabilizing asset during periods of uncertainty. Central banks view it as essential preparation for volatility. Central banks are preparing for long-term global volatility, shifting their focus beyond short-term market headlines. The third key reason is the risk of inflation and currency devaluation after years of unprecedented monetary stimulus. Years of expanding money supply raise concerns about long-term purchasing power. Currency erosion remains a core risk, even if inflation temporarily slows. Gold has consistently acted as a reliable protection against currency devaluation and the erosion of purchasing power. Finally, the fourth key reason is the growing concern over high sovereign debt levels worldwide. Global debt continues to rise, and real bond yields are weak or even negative in many regions, making bonds less risk-free than traditionally thought. Gold stands apart because it is not tied to debt or repayment promises. It is a physical asset with inherent value. Central banks operate with a long-term perspective. Their consistent gold accumulation signals strategic preparation for periods of monetary and political transition. Their actions reflect a strategic shift toward assets that prioritize systemic risk management and global financial resilience. For investors, this reinforces gold's role as a long-term strategic asset. Focus on structure, reassess portfolio balance, and prioritize long-term protection strategies.